right, folks, welcome back. It is time now for your Sunday Money. Last week, the U.S. Federal Reserve lowered its key short-term rate 0.25%. A viewer asks, why does the Fed raise and lower interest rates, and how does it affect my money? Good questions. Moneyman Paul Fain joins us now to explain why the Federal Reserve has lowered those interest rates. Paul, we hear about it in the news all the time. The Federal Reserve just says, hey, it's going to raise or it's going to be lowered. Obviously, they have their reasons.
Right. So the Federal Reserve, like you're saying, the central bank has several tools, Sean, that they use to nudge the economy or to slow it down, and several key interest rates are part of that. So they have three main objectives. One is to promote employment, which unemployment's very low historically. Stabilizing prices refers to inflation. So they've got a target rate of around 2% increase in the cost of living annually. And of course, they use interest rates to affect things like mortgages and long-term bond rates.
Okay, interesting stuff. And I know that there's a couple of terms that people really need to know about, like Dovish and Hawkish. What are those?
Well, just last week, I heard a commentator saying the Fed's being dovish. Well, that usually refers to when the Federal Reserve is lowering interest rates, kind of having an accommodative, an expansionary policy, trying to make it a little cheaper for us to borrow money, and the key is to spend money to keep the economy cranking. Hawkish just refers to the exact opposite, where the Federal Reserve is getting a little more contractionary, raising rates, trying to slow us down in our spending sprees.
Gotcha. Okay, that makes sense. So really, I mean, we talk about all this stuff. It seems like it's really on a macro basis, but really, this affects everybody's wallet, right?
Most definitely. So, from a lending perspective, it could be seen as a good thing, particularly with short-term rates that adjust more frequently. Think about home equity loans, adjustable rate mortgages, car loans. And, as we've experienced in the past, when the Fed is dovish, when rates go down, it's negative for our, savings strategies. So we know that savings rates right now are already low. They could possibly drift lower on things like money market accounts, savings accounts, certificates of deposit.
Huh. Very interesting. So
and I could interject, in terms of stocks and bonds, it kind of depends on the climate we're in to whether, lowering rates gives a little tailwind, maybe to the stock market, maybe to the bond market. I think right now there's more other macro issues like trade that are more influential in the stock market.
Yeah, no, we've done segments on that one too. And
absolutely.
That's a whole nother deal. So now for our fast market facts. So, Paul, what you got for us today?
Well, if you just put our finger on the pulse of various interest rates that we were just referring to, look out at the 30-year mortgage, it's around 3.75%, so still really low if you're in the market for a house or for refinancing. Adjustable rate mortgages, again, low, about 3.5%, and probably with a downward trend. And unfortunately, as we were saying, Sean, interest rates on our banks and savings CDs, one-year CD, probably under 2.5%. If you can get 2.5%, that's a pretty good rate.
Yeah.
And various savings accounts under 2%, often under 1% still in terms of bank interest.
Oh, man.
Hard to make a living.
Sometimes it can be
in your
hard.
savings account.
Well, good stuff, Paul. Thank you. So if you have a question for our money man, Paul Fain, you can email him at paul@assetplanningcorp.com. Paul, I know you love getting questions.
Yeah, it's fun. Yeah, keep the questions rolling in.